Hey guys, welcome back to another quick video.
Markets move fast, and so should your understanding.
Today we're going to be talking about ISO and NSO, right? Let's dive into it. A lot of people get confused between the two. They're very similar and the names are very similar. But there are some key differences that will impact which one is better for you as an employee. So what is an ISO and what is an NSO? An ISO, or an incentive stock option, gives the holder the right, but not the obligation, to buy company stock at a predetermined price on or before a specific date. Meanwhile, an NSO, or a non-qualified stock option, gives the holder the right, but not the obligation to buy company stock at a predetermined price, regardless of when the stock is granted. Both ISOs and NSOs allow employees to purchase company stock at a discounted price. However, there are some important differences between the two types of options that you need to be aware of. The first one is the strike or exercise price. The exercise price is the predetermined price at which the employee can buy the stock. For example, let us say Apple's current stock price is $150 per share, and I am granted 100 ISOs with a strike price of $100. This means that I have the right to buy 100 shares of Apple stock at $100 per share, which is the strike price, even if the market price of the stock has increased to $150 per share. With NSOs, the strike price is set at the fair market value of the stock at the time the option is granted. So in this case, my strike price would be $150. The second difference between ISOs and NSOs is the tax treatment. With ISOs, no tax is owed at the time the option is granted or exercised. However, when the stock is sold, long-term capital gains taxes will apply. If you're in the 12 or 5% tax bracket, you'll pay 0% in taxes. If you're in the 20% tax bracket, you'll pay 0%. If you're in the 28% tax bracket, you'll pay 20% in taxes. With NSOs, on the other hand, taxes are due when the option is exercised. This is because NSOs are treated as if you were purchasing the stock on the open market. So you've got to pay income tax on the difference between the strike price and the market price at the time of the exercise. Any subsequent sale of the stock will then be subject to long-term capital gains taxes, which are generally lower than income taxes. The third difference is the holding period. For ISOs, the holding period begins on the date that the option is exercised. So if I exercise my 100 ISOs for Apple stock today, and the stock price is currently $150 per share, I would have realized a $50 gain per share, or $5,000 in total. For NSOs, the holding period begins on the date that the option is granted. So if I was granted 100 NSOs for Apple stock today, and the stock price is currently $150 per share, primera julave, a $50 gain per share, or $5,000 in total, I would have to pay income tax on that $5,000 gain immediately. And if I were to sell all 100 shares of Apple stock tomorrow, I would again have to pay taxes on that $5,000 gain. Since NSOs don't have a set expiration date, the holding period for tax purposes would also not have a set end date. In summary, ISOs are better than NSOs because they offer more flexibility and can result in significant tax savings. The ability to defer taxes on unrealized stock gains until the stock is sold can be a major benefit, especially if the stock price is expected to rise in the future. Additionally, ISOs generally have a longer holding period than NSOs, which means that you can potentially benefit from long-term capital gains tax rates. If you enjoyed this video, please leave us a like and comment below. What other stock option strategies would you like us to cover next? We'll see you guys next time. Bye.